Hello, everyone. This is Vanessa Growlich, and today we're going to talk about risk, return, and we're going to start talking about the capital asset pricing model. I want today to show you how we do in math or in finance, how do we measure risk, and how do we measure the expected rate of return. And then the combination of that is what's going to help you understand the capital asset pricing model, which they also call the CAM. So let's first start. Now, I want to show you, I'm using this book as my reference, Financial Management. I think it's Brickham. I'm not sure it's Brickham or Brickham. I have to check that. But this is a great book, and I'm putting the link in the bottom. So that way, you can see like the free resources they have on their website. So first, let's start with risk. So what is risk? The definition of risk is the chance that some unfavorable event will occur. Well, you're really happy, you're gonna go to the beach, but you have the risk of maybe, it starts raining, maybe, for whatever reason, you get into an accident before going to the beach. So bad things, or what they call unfavorable events, can happen. Now, how do we measure this risk when we are investors? Well, when you're an investor, what you want to do is to see how much risk versus return you're going to get from your investment. Let's remember, the higher the risk, the higher the investor's expected rate of return. In finance, this is what we constantly do. You're basically trying to put your money into an investment that has really high return and low risk. So let's define the rate of return, and let's do the formula. So the rate of return formula is the amount received minus the amount invested over the amount invested. So let's say that you bought a toy, and I'm just putting an example, for $60, right? I don't know, let's just actually make this pen $60. It's a magical pen, whatever it is. And then you go and you sell it for 100. So what is your rate of return? Well, it's going to be 100 minus 60 divided by how much you spend to get the pen, which is $60. So your rate of return here is going to be 66.67%. You can use this formula in anything. Basically, amount received minus amount invested over amount invested. Now, when you are an investor, you want to figure it out where you stand, with your money. So that's the reason why we use probability. Now, let me just show you here on the screen what is a payoff matrix. So this is just a simple example, as you can see here. And you're going to see that investors basically are going to sit down and they're going to say, well, how strong or how normal or how weak do we think the economy is going to be, in the next year? And, depending on the sales, and they get all the big data, and then they figure out that the probability of a strong market is going to be 40%, or having like a lot of sales. Normal is 0.30%, and then the weak is going to be 0.30. Notice that the addition always must be equals to 1. Now, I'm just putting like an exaggerated rate of returns. If the market is really strong, they're going to get a rate of return of 40%. If it's normal, maybe 20% to be conservative. And then if the market is weak, minus 50% rate of return. Then from here, what we're going to do is that we're going to find the expected rate of return. All what this is the multiplication of the probability of occurring times the rate of return. And look, when I do it, and then I do the sum, this is why you have the formula here, how I have it in the screen. And let's just read it. It's basically the sum of the probabilities times the rate, and then you do it for all of them. Once you do P1 times R1 plus P2 times R2 and so on, then you add them all, and that's what you get, the expected rate of return. Perfect. We see here that our expected rate of return is 7%. Well, it gives me the reward, what I was looking, but now I want to figure out, how do I measure the risk? Well, this is what I'm going to do. I'm going to find what we call the standard deviation. When you take statistics, you're going to learn about the normal curve, right? And I'm putting it here in the screen. And you're going to learn about, the farther away you're from the mean, that means that the higher your standard deviation is going to be. The same thing happens here with the stocks. So let's find out the standard deviation of the payoff matrix that we had before. Now notice what we're gonna do. We're gonna have the probabilities like we did before. We're gonna have the rate of returns like we did before. And now we have the expected rate of return. So what we're gonna do is we're gonna do 0.40, which is the probability, minus expected rate of return to the square times the, the rate of return minus expected rate of return to the square times the probability. And you can see it on the screen, it's a little bit much easier. Once I do all that, then I find the square root of that sum, and bingo, I get 38.94%. Now, this is just a big number, but this is just basically for one portfolio, right? And then when you look at it and you say, well, that means that my rate of return is 7%, and my standard deviation or my standard risk, if you want to put it like that, is 38.94%. But it makes much more sense when you have actually two type of portfolios that have the same return, but with different standard deviation. And here is where the coefficient of variation comes to place. Now, the coefficient of variation is going to be very helpful because most investors are not going to have just one return. They're going to have more than one return. And sometimes they can see that the return has the same, the portfolio has the same return, but it has different standard deviations. Which one do you pick? You're going to pick the one with the CV or coefficient of the lower CV or the lowest, or the one that has the lowest coefficient of variation. For example, let's say that portfolio A has a standard deviation of 10, sigma, right there, as you can see it. And then you have your return of 5%. And then B, standard deviation 15%, and then return 5%. Notice that when I do the coefficient of variation, if I do 10 divided by 5, which the definition is just basically going to be the standard deviation over the return, you're going to see that B is way much riskier than A. As you can see here, we can figure out the relationship between the rate of return and the standard deviation by just doing the division. And if you have several projects, then your coefficient of variation is going to help you determine which one is going to have the more risk, or which one is, which one has the less risk. So let me just read you this definition from the book. The coefficient of variation shows the risk per unit of return, and it provides a more meaningful basis for comparison than standard deviation when the expected returns on two alternatives are different. Now, this is very important because, like I said before, when you have a portfolio, you're going to have many stocks. So now let's talk about what is called the correlation coefficient. Let me just show you first what is the correlation coefficient. The correlation coefficient, which is the letter, it's like a P and it's called rho, is the tendency of two variables to move together. Let's talk about the extreme value. So let me show you this really nice, this very nice picture that they have here in the book. And look what happens. You're going to have here what we're doing is comparing the rates of return of two perfectly negatively correlated stocks. And then you have portfolio W and M. So let me show you what this means. Let's make sense out of here. Look at this. You have here a stock W, right? And then you have a stock M. Notice how when a stock W is in 40, a stock M is on -10. So basically, it goes the opposite direction. When you see portfolio W and M, look at that. It's just basically just one constant line. Now, look at the math on the bottom. Notice that the average return will not change, but the standard deviation, if for a stock W is 22.64, for stock M is 22.64, but when you add both portfolios, this is only assuming that the correlation between them is -1. Look, all the risk disappears. Obviously, this is only in the book, Perfect Life. This does not happen because it will be extremely difficult to find, a correlation coefficient equals to -1 between two stocks because, again, nature is not this perfect like the book. Now, this is very, very important because what happens, as you can see, remember, the correlation coefficient shows you the tendency of two variables, how they move together. So look what happens when W goes up, M goes down. When M goes down, W goes up. So it's like one rescues the other, and that's what you want to have. You want to have a diversified portfolio where, you know, all of them, if, let's say like all your portfolio is, I'm just making an example. Let's say before the pandemic, all your portfolio was basically, you know, stocks in the movie theater and the gym, for example. The pandemic happens and boom, all your portfolio is going to go down. However, let's say that you have, you had a portfolio that one was, I don't know, Amazon, and then one that did masks, you know, and then you have the one for the gym. As you can see here, one of them is going to perform much better than the other ones, and it's going to rescue that loss. It's just basically having like, I call it like a backup plan, right? Like, oh, if this one falls, then, you know, this one is going to rescue me. Now, let's see what happens when the two portfolios have a positively correlation. Now, look at this. Let's see the screen. A stock W and a stock W are following the same direction. As you can see, a stock W, and stock W prime, when you combine them together, look what happens. The average return is still 15%, but the standard deviation, when they're both positive, is just basically, you're just basically having the same standard deviation on a portfolio than with the stock by itself. Finally, let's just do a much more real example. Let's say now that the correlation between the two stocks is plus 0.35. Now your correlation coefficient can only go from -1, then 0, and when the closer you are to 0, there's basically no relationship, and then you go all the way to 1. The closer to 1, obviously it's going to be more extreme. The closer to negative is going to be extreme, and when you're in 0, there's no relation. So very important. If someone tells you that you have two events, A and B, and they are negative correlated 98%, they actually have a really strong negative correlation. So don't think because it's negative, it's not a strong correlation. The higher, the closer you are to -1, the stronger the negative relationship between both of them, and the closer you go to 1, the positive the relation. Now, if your correlation is weak, it's going to be very close to 0, because basically, you know, the tendency of the two variables moving together is not that strong, to put it that way. Now, look at this one. So here, rho, or the coefficient of correlation, is 0.35. Notice that now both portfolios, right? You have a stock W and you have a stock Y. And when you put them both together, look what's going to happen. The average return stays the same, 15%. But when you do the standard deviation, notice that your risk actually went from 22.64 to 18.62. Conclusion, and this is the most important thing you will always learn in finance: diversification does nothing to reduce risk if the portfolios consist of stocks that are perfectly positively correlated. So you can see here what we're doing is try to minimize risk, because when you when you diversify your portfolio, what are you doing? You cannot completely eliminate risk, but you can kind of say, okay, if this one falls, this one will pull me up, like I said before. Now, let's talk about the two types of risk that we're going to find. Well, we're going to find first what is called diversifiable risk. I think I said it correctly. And this one is just basically caused by random events. This one is just basically caused by random events, particularly within the firm. So, you know, what can happen here? Things that you can basically control because they're like well, it's not like you can control it, but you can, you know, eliminate the risk. So for example, like random events could be, they put here like a contract that basically didn't go through, or maybe having a lawsuit. Maybe the CEO did something that, you know, he shouldn't or she shouldn't have. Now, market risk is the one that you cannot diversify, and it's basically the one that, you know, you can suffer because you have no other option. Best example, war, inflation, the pandemic. I think after they print all these books, there's going to be so many cases about the pandemic that, oh, well, students doing their MBA is all going to be, and the pandemic and the corona and what happened with this company. So I can't wait to look forward those cases and see how, you know, how they're going to be handled. But then where do we go from all this? Now, today we just talk about reward. Today we talk about risk. We talk about the coefficient of the correlation, right? Like basically the coefficient, coefficient of variation. And we basically discuss how companies, when they have a stock, how they measure the risk, how they measure the standard deviation, how they measure the return, the two type of risk. From here is when we're gonna start next time what we're gonna call the capital asset pricing model. This is going to be the following, and I read it. This is just going to be, it's an important tool used to analyze the relationship between risk and the rates of return. You're gonna love this, the next podcast too, because we're gonna talk about beta, we're gonna talk about the security market line, and you're basically going to understand when you're reading Yahoo Finance why the stocks behave the way, or basically the math behind that. So thank you so much. I hope you enjoyed this a small little lesson about risk, return, and just the beginning of what we're going to talk about, the capital assets pricing model. I thought it was a little bit much easier if I would just subdivide it into pieces. So stay tuned that the second part is going to be coming pretty soon. Thank you so much. This is Vanessa, and have a math day.